Hello and welcome back. Today's video is true crime, white collar crime, but it is broader than that because we're going to talk about the 1980s savings and loan crisis, also known as the savings and loan debacle. And so this debacle was a slow-moving financial disaster that was caused by economic changes, really terrible government policy, and as always in these videos, greed. Lots and lots of greed, and resulted in a lot of fraud and crime. Prior to researching this video, I had never heard of savings and loans as an institution. Like, I know what savings are, I know what loans are, but I didn't know that savings and loans was the name of a type of financial institution in the United States. It's abbreviated to S&L, S&L, not S&L for Saturday Night Live, but S&L. They are also referred to as thrifts. Savings and loans are thrifts, but thrifts encompasses more than just savings and loans. So I'm going to call them S&Ls in this video, and also thrifts. And prior to the crisis, S&Ls provided over half of all home mortgages in the United States. By 1989, more than 1,000 of these financial institutions had folded, and by 1990, they only accounted for a quarter of home loans. S&Ls still exist in the United States. There are only I think 650 of them, and after everything was said and done, the re-regulation, the deregulate, all of it, they really aren't the same as what they used to be prior to this crisis and all the terrible policy that came after. When the crisis was over, hundreds of bankers were criminally charged. So this debacle, unlike the 2007 subprime mortgage crisis, actually resulted in a lot of people facing criminal charges. There's so much to cover here that I'm going to split this into two videos. Today's video is going to cover the history of S&Ls, what they are, where they came from, the economic changes that resulted in S&L starting to collapse as an institution, and then the disastrous deregulation during the Reagan administration. I'm also going to cover sort of broadly some of the fraud that the S&Ls engaged in, and then sort of how this was resolved. In the next video, I'm going to talk more about one of the most egregious criminals and notorious criminals. His name is Keating, and that's going to get more into the politics of why it unfolded as it did. Politics and money and greed, and they all go hand in hand. So this is a very complicated story. It occurred over 10 years, but at the same time, it is deeply uncomplicated. We had these banks, and they suffered from bad policies in the 70s, and to solve that problem, they suffered from even worse policies in the 80s, and that's about it. And by the end of it, this kind of institution just doesn't really exist anymore, not as it was. So let's get into it. Savings and loans, where did they come from? They came out of FDR's, Franklin Roosevelt's, push to increase home ownership. So prior to FDR, home mortgages in the United States were only for 5 years. So if you imagine today that you only had 5 years to pay off your home, most people couldn't do that. And that was true back then as well. Owning a home was really only for the upper middle class and above. And so the Federal Home Loan Bank Act of 1932 created 30-year home mortgages, and that made owning a home much more affordable for people. Mortgage payments split over 30 years versus 5 years. It's pretty simple math. This industry of specifically home mortgages was regulated differently than commercial banking. And this is going to matter way in the future in the 80s. But generally, oversight tended to be weaker. And I think this probably made sense for a while. Home mortgages are kind of simple. People generally know what a home is worth. You can look at the neighborhood, you can look at your neighbors, and you can say, okay, like everyone's home in this neighborhood is worth this amount of money, more or less. So it's not like risky. You're not necessarily depending on the expertise of appraisers. Like obviously we get appraisals for homes, but it's not like you're only depending on that one guy to not be a corrupt liar, you know? So in certain ways, home mortgages are simpler in terms of like investments and what's going on there. Savings and loans, or thrifts in general, came out of a tradition of co-ops. And so this was something where neighborhoods would essentially make like their own cooperative bank. Everyone would put in money, and it would allow for people to buy their homes in that neighborhood. So these were not for profit institutions. They were, again, like neighborhood run co-ops to allow your neighborhood to be better because people could buy their own property. That was sort of the tradition where thrifts came from, but S&Ls weren't co-ops. They were for profit. But again, they weren't commercial banks. They weren't only for profit. Coming out of this history, this tradition, it was kind of a boring business where, yeah, like you took deposits, the savings, and you gave an interest rate, you know, whatever it is, something low, and then you gave mortgages, home mortgages, and that was it. It's like pretty easy work there. Mortgages are pretty stable. Prior to 2007, everyone always believed that everyone would always pay off their mortgages, so it was just a kind of simple business that wasn't like high profits, high reward, high risk. It was none of that. And to make it even less risky, the National Housing Act of 1934 created the Federal Savings and Loan Insurance Corporation, which is FSLIC, and I'm sorry to say that people in the business call it FSLIC. So FSLIC is the insurance corporation, and what FSLIC did was insure the deposits that people gave into these banks. So if I put in $20,000 into my local savings and loan, you know, and they give me interest, so I'm slowly accruing interest on my little nest egg. FSLIC insured that money. So if the savings and loan closed tomorrow insolvent, FSLIC would pay me back my $20,000. So that was the point of FSLIC. The other important institution that oversaw S&Ls and FSLIC was the bank board. And so these are politically appointed government institutions. Okay, so what is an S&L? I've already mentioned people put in their savings, the deposits, and then they get their loans. I mean, that's really it. They had a joke about it that was like 363 or 336, where they would pay 3% on deposits. So that was the interest rate you're getting for depositing your money. They offered 6% on mortgages. So that's the interest you pay on your mortgage. And they were on the golf course by 3. So again, not an exciting business, very steady. The way that it worked is they competed with other thrifts and banks for depositors. So they would have to have competitive interest rates there. And why this matters is you need money coming in, even though those are debts to the bank. You know, if I deposit at the bank, that's a debt they owe to me. They owe me that money back with interest. But they need that money so that they can loan it out to other people with higher interest rates. That's the whole business. And so they have to compete for depositors. If they don't get money in, they can't send money out. And so there was some competition with the interest rates that they offered. One of the earlier regulations from the federal government was to forbid banks from going over certain interest rates in attracting customers. There's debate over whether or not this really affected S&Ls in the long run. Some people think this was a problem. Some people think removing that rule, which they eventually did, was a problem, because then they started, offering absurd interest rates that they couldn't hope to pay back. And some people think this is a red herring. It's not really the issue. But because thrifts were pretty much only used for home mortgages, they couldn't diversify their investments. That was it. Their investments were home mortgages. And that was fine if interest rates didn't change too much. So as long as interest rates stay steady and there's not terrible inflation, only investing in home mortgages will work out. So lending money over long periods of time is only profitable if the money is worth roughly the same at the end as it was at the beginning. So if you have inflation, which we always have, if I lend you up front $100,000 and 30 years later you pay it back, that $100,000 is no longer worth as much as it was 30 years ago. You can think, like, how much did, a soda cost 50 years ago? Something you could buy something for a nickel. Like, nothing costs a nickel anymore, right? That's inflation. So, the way to get around this, or to keep it profitable, of course, is to have interest rates, and to make sure people are paying back in installments. So even with that, at the end, the mortgage payments they're making simply aren't worth as much as they were at the beginning. Now, if you couple that with changing interest rates, now you have a real problem, because the depositors can pull out their money at any time. So if I, deposited my $20,000 into an S&L for a 3% interest rate, and then interest rates fluctuate wildly, and now they're like 8%, I can just pull my money out and then put it back, or put it in a different institution, find somewhere else where I can get a better rate of return. And now S&Ls are stuck paying those debts when the 30-year mortgage they had, you can't, at that time, it was illegal to change interest rates on. So if I got a mortgage for, 6%, but now interest rates are way up, I got a steal, but the S&L is suffering. This is called maturity mismatching, and it is exactly what happened in the 70s. So if you remember your history, or possibly lived through it, there was massive inflation in the 70s. And basically, the cause was Nixon's terrible policies. He was overly concerned with getting reelected, and a concern that also caused him to turn to crime. That's a whole different subject. But he was very worried about unemployment rates and the economy, and so he enacted policies that in the short term would make the economy look healthy and good, and in the long term resulted in very high costs for our country. These policies included running a high deficit, enacting price controls, which are legal minimums and maximums for specified goods like rent, gasoline, and food. And he also broke the last link of the American dollar to gold. So American dollars were no longer backed by gold. This caused a devaluation of the American dollar abroad, which caused other issues for us. And Nixon believed that artificially low interest rates would prevent a recession. He was advised against doing this. Economic experts were like, don't do this. And he basically bullied the chair of the Fed, saying inflation was fine, but unemployment was not. And surprise, he eventually got both. So in the short term, his terrible policies did make the economy look good, and he won his re-election. For all the good that did Nixon. However, by 1980, inflation was at 14%. policymakers generally hold that healthy inflation is at about 2%. Right now in America, inflation is at 4%, so it's like a little bit higher than it has been the past 5 years, and there are some concerns about that, but 4% versus 14% in 1980. And then, as an aside, the USA basically blamed OPEC and oil prices for causing this, but looking back at history, it is generally agreed upon that we did this to ourselves. This was just some bad economic policy that caused these problems. So, with the Carter administration, one change is that they eliminated that previous rule that limited interest rates that banks could give to depositors. Again, there's some debate about this. Some people consider this pretty bad for thrifts who know how to compete with other banks to attract depositors. This was, an expense for them because they're paying out that extra interest. And meanwhile, the mortgage side of the business was entirely stagnant. With inflation, their old mortgages they had are like basically worthless. And, the money they're getting from that just wasn't enough to stay afloat. So the result of all of this is that by 1980, for S&Ls, profit had dried up and they were in a lot of trouble. So let's set the stage for what's going on coming into 1980. We had these S&Ls with stagnant profit and yet increasing costs, so they're not doing well. As I mentioned way back at the beginning, they had weaker regulatory oversight compared to commercial banks. One reason for this was that regulators of S&Ls were paid less than those of commercial banks, and it was essentially the same job, which meant, if you could, you were going to regulate the banks, and so, no offense, but the S&L regulators tended to be sort of bottom of the barrel. And so in 1980, FSLIC, that federal insurance for deposits, insured about 4,000 S&L institutions with assets of $604 billion. There are around 600 more institutions that were state insured. With the inflation of the 1970s, S&L suffered from that maturity mismatch I mentioned, and the first 2 years of the 80s, income for S&Ls as a group went negative. In 1982, the entire industry was deemed valueless, and it was losing more money than it was making. During the past 45 years, 143 thrifts total had failed, and that had cost FSLIC $306 million. Between 1980 and 1982, 118 S&Ls failed, costing FSLIC over 10 times that amount at $3.5 billion. This was apocalyptic for this industry. It was imploding. And FSLIC basically didn't have the money to close all of the insolvent banks, and this is where the bad decisions come in. At the end of 1982, there were 415 insolvent thrifts, and had FSLIC stepped in at this point in 1983, it would have cost around $25 billion to close these institutions. However, FSLIC only had $6.3 billion in reserves, so it didn't have the money to do what it needed to do and what it was created to do. So, in a reasonable world, or perhaps a world that is based on hindsight, what should have happened is the thrifts should have been shut down. They were insolvent. The business had failed. You can sell off loans, you can sell off bundles of mortgages. We know this because of what happened in 2007. But the consumer losses from the deposits would have bankrupted the insurance agency, would have bankrupted FSLIC. And this was politically not something anyone wanted to deal with. Nobody wanted a bailout. Nobody wanted this expense. Moreover, at this time, Reagan was trying to get a tax cut through, and he eventually did, but to do it, he lied. I don't actually know if this is a crime, it certainly was dishonesty, because his administration knew they were on the hook for this, at this point, $25 billion, but they didn't count it in the federal budget. $25 billion that was missing, and they didn't want to. This was on purpose because they're trying to cut taxes. Nobody wants to add an expense. So they just didn't exactly deal with it at this time. Additionally, many of the heads of these S&Ls were friends with regulators, and many of them, of course, were giving money to politicians, and that's going to feature a lot more in the next video. So instead of doing the responsible and painful thing of pulling the band-aid off and killing this industry, the Reagan government went with deregulation. And now, I'm not saying the Reagan administration engaged in this crime, although some politicians absolutely were engaged in this crime. Instead, they created, through deregulation, an environment where crime became incredibly pervasive. Not every single S&L became a fraud, but like a lot of them did, like so many. And when you hear about all the different deregulations that went through, it's not terribly surprising why. So let's talk about this deregulation. It was in 1982, Reagan deregulated the S&L industry. And I'm going to go over a number of deregulations that created this situation. The first one is kind of simple. The amount of money that S&Ls had to keep from their deposits on hand decreased, so they could put more money into investments and not have it on hand for customers who wanted to cash out. This increases risk. If I take $20,000 from you and I loan out $19,000 of that money and you want some of your money back, I don't have it anymore. I loaned it out, and some of those loans might fall through. Some people might default, so that's risky. They also encouraged new S&Ls to open, as the requirements for those S&Ls were even lower. They basically didn't have to have any cash on hand. They could just open, get as many deposits as possible, and start investing like mad, and that is exactly what they did. Thrifts were now able to invest in more than just home mortgages, so they invested in riskier commercial estates and junk bonds. Some sources made a big fuss over the junk bond aspect, but I think it's pretty agreed upon that the commercial investments were a much bigger problem here. And I talked about this briefly before. The reason that commercial properties are riskier than home loans is because it's not always clear how much a commercial investment is worth. Again, I can look at my home and look at my neighbor and say, okay, my home's probably worth about the same as theirs. But if you look at a commercial property on the street, it's not as clear. They vary in size, they have different things going on inside, different facilities. The location matters in different ways. It's not as obvious how much a commercial property is going to be worth, which means you have to rely a lot more on the appraisers, and appraisers can be and were corrupt. Also, they got rid of the limit on loan to value ratio. So previously, banks weren't supposed to loan the entire cost of the work. If I wanted to build a commercial property for $100,000, maybe the bank would only loan me $70,000 and I would have to come up with the rest. They got rid of this regulation, so now I could get the entire $100,000 from the bank, which again is much riskier, because if I don't have to come up with any money at all, I could be a con man, and many of them were. So Again, this increased the risk of the investments they're making. They changed how S&Ls were able to report capital. So this didn't necessarily make the S&Ls engage in more risky behavior, but it allowed them to pretend they had more capital than they did. They were able to amortize losses. And amortize means to break something up over the course of months. So let's say, I went to a slot machine today and gambled away $2,000. That would show up immediately in my bank account. I now don't have $2,000. However, if I'm able to amortize that loss over 2 years, well, now it doesn't look so bad. And if someone were to look at my bank account, they'd be like, oh, well, yeah, she spent some money on something stupid today. They wouldn't see that I lost $2,000 because I broke it up over 2 years. And so this is just kind of like tricky accounting, which could be used by legal, lawful, ethical people, but could be abused by unethical, immoral, fraudulent people. Okay. Another new rule was that previously thrifts were required to have at least 400 stockholders with nobody having the dominant share. This meant that there was no one person who owned the S&L. It was owned by many people, and again came out of that tradition of it being like a co-op. 75% of the shareholders were also required to be local. So again, this was, these were community banks meant to enhance a neighborhood by allowing people to get home mortgages. This rule was completely eliminated. Now one person could buy an S&L, which increases the risk of bad actors, because if you have one person in charge of a bank, that person now has incredible power over what happens, including the power to loot the bank for all it was worth, which absolutely happened. We'll talk a little bit more about that, but this did result in the turnover of a lot of S&Ls, because if you, again, are a scrupulous, ethical person who is a part owner of an S&L, and this industry has gone belly up, and someone offers to buy it, you're going to say, yeah, this investment for me is not good anymore, and I don't see the future for S&Ls given how things are, so I'm going to go do something else with my time. But a bad actor, they see this as an opportunity, and so they're going to buy an S&L and start acting badly. There was also, under Reagan, a hiring freeze from 1980 to 1981. So Reagan hated big government, of course, it's a big thing of the Republicans, and so he froze hiring. They couldn't get new regulators. Regulatory industries were badly understaffed and underpaid. They also weren't given training for how to regulate with all the new rules in place. So, we have badly staffed, understaffed, badly paid. Previously mentioned that, you got better paid to regulate commercial banks. So you've already got these people who are bottom of the barrel, or, not sure why they didn't get hired over there. And then moreover, regulatory officials lacked certain key abilities to mitigate risky behavior until 1987, which was far too late for this debacle. But the one regulatory change that I think everyone agrees was the worst decision had to do with something called goodwill. And I'll admit, I read numerous sources on this because what they did was dumbfounding. I cannot understand why this happened the way that it did, but I do believe I now understand what happened, at least, because when I first read about it, I was like, none of this makes any sense. it turns out I was right. None of this makes any sense. So let's talk about goodwill. Under normal circumstances, goodwill is the idea of intangible benefits you might receive when purchasing a business. So, for example, you have a business whose net worth is $10 and I buy it for $12. Well, clearly I have valued your business $2 higher than it should be valued. And so the logical conclusion here is that there is $2 of intangible benefits I'm getting from your business. This could be a super loyal client base. This could be the location. This could be that I'm getting rid of competition for other businesses that I own. This could be, that you have like a really noticeable logo or, something that brings people in. And while it doesn't affect necessarily the net worth of the business, for me, there is value in it. And that value, we can give it a value. It's $2 extra in this ridiculous example. So that is what goodwill normally is. And you mark it in the books. Like when you write down the net worth of the business, once I paid $12 for it, you count $2 of goodwill. Okay, so in the context of S&Ls, what's going on here? Well, the head of the bank board who was regulating the S&Ls thought the best way to solve this would be for the insolvent S&Ls to merge with healthy S&Ls. And that way FISLIC wouldn't have to pay out any of the debt. We could just, shove all these S&Ls together and hopefully they would float on through. So to make this easier, they changed how supervisory goodwill went on the balance books. And they did it in a way that deeply encouraged fraud. When one S&L merged with a second S&L, these S&Ls were worthless. In fact, they cost money. They were insolvent. They were in debt. And so they weren't going to pay money for these things. But even so, why would you merge with a business that only has debt, has more debt than assets? That's bad for your business. You're going to have to pay that debt now. And so what they did here is say, okay, if this S&L is $20 million in debt and I choose to merge with it anyway, well, clearly it has $20 million worth of goodwill. Okay, so then the S&L that merged could take that $20 million of goodwill and count it as an asset, and put that asset on their balance sheet basically as a profit. So in a healthy and scrupulous situation, how this would have worked is a big healthy S&L would take a small healthy or a small insolvent S&L and merge with it. And the reason they might do this is because, again, maybe that S&L is in a different part of the state and they want to branch out to that city. Or maybe that S&L was competition for them, and now that it's gone, now that they've merged, they can go ahead and increase interest rates and make more money, and so it was worth it in the end. That's how things would work, if people were scrupulous and good all the time. What actually happened was more like this. If I have an S&L that's $10 million in debt, I'm insolvent. I can't pay it. My S&L is worthless. And you have an S&L that's $20 million in debt, insolvent, I can merge with you, count your negative $20 million as goodwill, put that on my books as profit, and now say as a merged S&L that is $30 million in debt, I can say we have $10 million in profits. And if that doesn't make sense to you, it's because it doesn't make sense. This actually encouraged insolvent S&Ls to merge with more and more insolvent S&Ls. The worse an S&L was doing, the bigger the profit you could put on your books. If you were $50 million in debt, I could put $50 million in goodwill on my books. According to the Office of Thrift Supervision Director, Timothy Ryan, while testifying before the U.S. House Committee on Banking, Finance, and Urban Affairs, Subcommittee on General Oversight and Investigations, this regulatory change allowed thrift institutions to literally manufacture earnings and capital by acquiring other thrift institutions. This is as fake as it sounds. It's nonsense. And it was a problem. So, okay. What were the results of this deregulation? At first, these measures seemed to work. By 1985, S&L assets had gone up by over 50%, which is remarkable growth. Although, as I just mentioned, a lot, in fact, almost, I think all of it, was entirely fictitious. The growth was driven by fictitious earnings from goodwill mergers, an influx of money being deposited with the new interest rates, and then investments in risky business ventures. And I'll talk more about how a lot of those commercial business ventures were also just entirely frauds. Seeing the kind of money flowing into S&Ls, the ownership of S&Ls rapidly shifted toward risk takers. It is funny to see different sources for what happened because some people really gave S&Ls the benefit of the doubt, but I read a book by an insider who was regulating, and he's like, these guys were all just criminals. Like, they weren't risk takers. Their behavior wasn't risk taking. Risk taking behavior has like these types of signs, whereas criminal behavior has these type of signs, and everything they did was just straight up criminal behavior. I'll talk a little bit more about that in a minute. Also, different states were changing their laws to make it easier and cheaper to open S&Ls, and that was specifically California and Texas. So new S&Ls were opening, which is not great for the country at all. There were too many lenders chasing too few loans. Competition was driving interest rates unfavorably for everyone involved. This actually affected commercial banks too, and they ended up acting in riskier ways, and the quality of lending services went down as a whole throughout the country. In 1981, 78% of total assets of S&Ls were in home mortgages. By 1986, home mortgages made up half of total assets. And during this period, we also got the rise of zombie banks. So what is a zombie bank? So this term came out of the S&L debacle, but it has been used since then. These were thrifts that were insolvent, but continued to act as if they were not. And so they had the government backing from FSLIC to pay off whatever debt they were in. And the government basically accepted these zombie banks because they were so afraid of having a run on the banks. So the goal was to prop up the dead banks in hopes to, save the healthy ones from being affected. There's a lot of debate about whether this zombie bank strategy works. That's beyond the scope of this video, but this strategy has been employed elsewhere, including Japan in the 90s and Europe in 2008. So, okay, let's talk about fraud. Everything I've mentioned up until now was legal. Not great ideas or sustainable ideas, but like the goodwill thing, although it was fraud, it was also legal fraud, if that makes sense. Because it was tricky nonsense accounting, but it was accounting that was given the go-ahead by the bank board, unfortunately. But now I'm going to talk about crime. And there was a lot of it. So I mentioned that the banks had a lot of turnover in terms of ownership. One fraud was run by a man called Herman K. Beebe. might be Beeb. I'm not Beeb or Biba. I'm not totally certain how to pronounce his last name. But he was a convicted felon from the New Orleans mob, and he paid other wannabe fraudsters to buy insolvent S&Ls. Those fraudsters would then lend money to Beeb that he would default on. He had no intention of paying that back, and he would keep the money, and then the new S&L owners and new fraudsters would pay themselves big bonuses for giving out such good loans and getting such a good deal for their S&L, and they all profited and the American people suffered. So that was going on. But the big one, I think and to me sounds like the most common one, and one that really affected a lot of the southwest of America, was called ADC fraud. And ADC stands for acquisition, development, and construction. Acquisition is the purchasing of a land for real estate development. Development is things like adding roads and sewage line, and construction is building the property on your new real estate. Under normal ethical circumstances, if you want to develop a property to build, an office building, for example, you would get an ADC loan. In a properly functioning world, you would pay a down payment to the bank, you would have collateral in case you defaulted, and the loan would come to you in installments depending on completion of certain parts of the project. This is not what happened at all in these frauds. Here's how it worked. There was no down payment from the developers. They didn't have to pay anything at all at the time of the loan. No risk on their part. They had no collateral. They used the project itself as collateral, so if they defaulted, the bank then claimed like a half-finished project. Again, this is no risk to them. They could do the project or not, and if they don't, then, the bank just takes what they didn't do. There was no personal risk to the developer. If they defaulted, that went on their company. Their company was on the hook, but the developer himself or herself was not on the hook for that money. They personally didn't owe the loan. So a lot of these developers used shell corporations, shell companies. They didn't care if that company went bankrupt. It didn't mean they would just, cash out and leave. The developer was also given a nice bonus at the start of the loan, sometimes up to 2% of the entire loan. So the developer here is getting paid to take out a loan, and there is absolutely zero risk to them. So this is a great deal for developers. On the S&L side of things, they charged hefty fees for these loans, but they did not charge the developer up front. The developer didn't pay these fees. The S&L wrapped it into the loan, and so the S&L paid themselves these fees with the idea the developer would pay it back. And because the developers were often super shady people with bad credit histories, the S&Ls were able to charge really, really high interest rates, which was good for their books, right? Because they could write down, okay, we got this high interest rate, that's tons of profit, we loaded in all these fees, but they were paying 100% of the loan, not in installments, which meant they were paying all these interest rates to themselves with the idea that the developer would pay it all at the end. There actually was no payments throughout the loan. They paid it all on the maturation of the loan some 2 to 3 years later, which is just insanely risky, just bizarrely risky. And so you might wonder, why was this good for them? Why did they want these high interest rates from sketchy people? Why did they want these high fees they were paying themselves? And the answer is really simple. They didn't care if the loan was ever paid back. By putting it on the books as profit, they could give themselves super high salaries, bonuses, perks. They could buy a company jet, whatever. They could say, we are making buckets and buckets of money, so I deserve a bonus, and that's exactly what they did. Now, one other aspect of these loans that actually caught regulators' attention was that they were often given an equity kicker at the end. This is an interest in the developer's profits on the project, and these kickers were often over 50%. And this changed the loan into an investment. And there is a difference here. For example, if you ask me for a loan to start your business and I give you $1,000 and you decide to spend that money on a new computer for yourself and you don't start a business, you still owe me $1,000. I loaned you that money. Hopefully I wrote a little contract because you're still on the hook for $1,000 no matter what you did with it. If you come to me and say, hey, Viscaria, I have a business and I want you to invest in it, give me $1,000, and I say, cool, okay. And then you waste that money on not a business, well, you don't owe me any money back. I invested in your business and your business is non-existent. So my investment is non-existent. I don't get any money back. So that's the difference. And this was actually still regulated somewhat in the industry. And so this did get the regulators' interest. And what happened is they were like, well, it can't be an investment. It has to be a loan. So the equity kickers started being like 49% of the project. I'm like, oh no, it's just like a little extra. But this was still pretty sketchy. So the S&Ls who were engaging in this ADC fraud reported massive profits, like 1,000% growth from the previous year. And when I was reading about this, I was like, okay, but these loans were for 2 to 3 years. So what happens after 2 to 3 years? No one wants to have their cash cow die, right? Like, these fraudsters wanted to make a life out of doing fraud. And what happened is so obvious. I mean, I'm just not a criminal. They refinanced the loan. So the game would start over and they would pay themselves big bonuses for refinancing. They'd say, oh yeah, all these fees, you owe us all these fees. But again, they roll the fees into the loan. The developers are never paying anything and the fraud would continue. Regulators did notice this one, so they had some other ways of getting around it. One was called cash for trash. And this was so clever and terrible. Let's say someone comes to your S&L and asks for a loan for $5 million. And your S&L says, no, we won't give you that money, but we will loan you $35 million if you buy this property for $30 million. Now that property is currently owned by a developer who's about to default on their $20 million loan. So what happens is this: your new developer buys that $20 million property for $30 million, and you can say, look, this property was profitable. The developer made $10 million off of it, and they paid us back our loan. Everything's hunky-dory. Meanwhile, the actual property is probably worth like $10 million, and you can just keep playing this game as it goes along. You've also lent yourself the money to pay back the loan. So again, no loan was being paid back. You lent someone else $30 million so that the other guy could pay you $20 million. It's, just lending yourself money. And then there was yet another way to get around people defaulting on their loans, and that would basically be like the S&Ls would sell bad loans to each other. So if someone was about to default, you could sell that property, whatever, to a different S&L and just sort of like hide your trail of how many defaults you're having. Because of course, if everyone is defaulting on their loans at your S&L, regulators might notice after a couple of years. Okay, so people started to notice after a couple of years. And the place that was worst hit in the country was Texas, for a number of reasons that I haven't gone into. Texas became a hub of rapid growth. There was far too much real estate being developed there, or being developed. People were buying up so much real estate and then building like half a condo unit on it. And there were early warning signs, but they went ignored mainly for political reasons. Again, people who had clout, people who were buying off senators, that sort of thing. So these were all ignored. An early casualty was Empire Savings and Loan Association of Mesquite, Texas. This S&L's assets went from $13 million to $300 million in just 2 years. And when it failed in 1984, the government was on the hook for $250 million in insured deposits. It also gained custodianship of 3,000 condominiums that Empire had funded. So this was the first Texas thrift to go under, and everyone at the time thought of it as like an anomaly, as something, like they just made bad decisions. But it was not an anomaly. It was pretty much par for the course with these Texas S&Ls. In 1992, 2 Dallas developers were charged and sentenced to forfeit around $80 million, and the former chairman of Empire was also charged. There was video of parts of Texas that had like all of these half-developed areas, like roads half-built, all of these like shoddy construction projects that nobody ever really intended to finish. These developers, once they got their loan, they would hire, often they would hire essentially their own construction crew, people, their own other business to do the work. But they would cut costs, they would buy shoddy material, they would charge high amounts of money to their other business and, just pay themselves out of the loan and then default and have like a half-built, really, truly terrible building that was useless. There were roads that were built with like 1/5 of the concrete that was necessary to make the road, and they were never going to work. So this kind of trashed an entire area of Texas. And as a result of this, Texas thrifts accounted for 62% of all losses nationwide, and Texas faced a worse recession than the rest of the country. It also depressed real estate prices. And there's some debate here. There was a real estate bubble that was already growing because of a different Reagan policy. Some people actually think that the S&L debacle and the way it affected real estate popped the bubble a little earlier than it might have popped otherwise. So in that way, it might have actually been kind of good for the real estate bubble. Hard to say. This also resulted in all Texas banks having to pay higher interest rates because the population entirely lost trust in them. I mean, I don't know if you can imagine every bank in your city or your state being involved in massive fraud. I think it would be really hard to, want to put your money there. I mean, if every bank in your state was closing and the people in charge of them were going to prison, that would definitely affect your ability to trust banks in general. So how did this all get resolved? Well, resolving it was made incredibly difficult because of political pressures. And again, I'll talk more about this in the next video. But the heads of S&Ls lobbied hard to continue deregulation, to prevent re-regulation, to get rid of oversight. They were trying to get their people placed on the bank board, and they were engaged in all sorts of stuff. In 1987 and 1988, FISLIC was able to clean up some of the insolvent S&Ls, but real resolution did not occur until the Bush administration. And weirdly, this ongoing crisis was entirely ignored during the presidential campaign. Like, for all that these banks were failing all over the place, and Texas was a wreck, it really didn't come up. And as soon as Bush got into office, in February, right after inauguration, he enacted the Financial Institutions Reform, Recovery, and Enforcement Act of 1989. This made minimum capital requirements, raised insurance premiums, and limited non-mortgage related holdings to 30%, and it also required divestment of junk bonds. It's really the non-mortgage related holdings that killed all of the fraudulent S&Ls, because they were the ones doing all this ADC fraud and not doing mortgages at all anymore. And so once they weren't allowed to invest in these fraudulent commercial buildings, they folded. That was it for them. And they also created the Resolution Trust Corporation, whose job was to wind down the failed S&Ls. And by the end, they liquidated more than 700 of them. The final cost to the American people was $132 billion. And that number doesn't include any of the payouts made before 1986 or any of the state insurance payouts. And again, had they dealt with this problem in 1982, it would have been like a third of that. S&Ls basically stopped existing. There are technically still around 600 S&Ls in the US, but they're really not the same institutions that they used to be. Over 1,000 bankers were convicted by the Department of Justice after the S&L debacle. And this debacle was believed to have contributed to the recession in 1990 through 1991, again, as well as a slowdown in the real estate market. There's also evidence that this debacle and how it was handled led to the 2007 subprime mortgage real estate financial crisis. One sort of simple way in which the one crisis led to the other was that prior to this mess, S&Ls were very safe and very boring financial institutions that didn't exist for making tons and tons of money or, maximizing profit. They existed to provide a service to communities, to help people buy homes, and reach the American dream. They were sort of beloved in America. If you've ever seen the movie It's a Wonderful Life, the protagonist, his bank is an S&L, and that's the sort of feeling people have with it, that this is a community bank meant to help people, versus commercial banks, which do exist to maximize profit, at the expense of literally everyone else. And so, changes to how mortgages are handled and the general change in how people see banks, I think, plus a bunch of regulation stuff, all led to the crisis in 2007. And I do think that our country is made poorer by the dissolution of S&Ls. I don't know that we've ever hit 14% inflation after that. The thing that would have prevented all of this in the first place is something that does exist now, and that is adjustable rate mortgages. So one of the reasons the S&Ls collapsed, or financially, is because interest rates changed. Well, with an adjustable rate mortgage, you can adjust the mortgage and respond to market pressures, and those exist now. Back then, they were illegal. So, I do think this debacle was very interesting to learn about, especially because it is such recent history. I don't think I learned any of this in school. I'd never heard of it until a friend sent me a note on it. He said, if you're doing financial crimes, this one's a doozy. And it was, and we'll cover more of it in the next video. It's going to be more political, I think, but also still lots and lots of financial crime. Charles Keating was a bizarre scumbag, and I look forward to telling you all about him. Okay, good night. I would like to give a very, very special thank you to my patron, the Groucho. You can support me on Patreon now too, and get a couple little behind the scenes videos and downloads of the audio files for my true crime series. Okay,